Let's start with chapter 13. This course is principal accounting second part, and we're going to start with chapter 13, which is deal with the corporation and how the corporation get the capital and what they're doing with the capital and how they're presenting the balance sheet. Now, this course, the entire course, is dealing with something very simple. Before we continue with the chapter, I want to bring your attention to the very basic stuff because I want you to remind yourself of the basic. Everything starts with the basic and ends with the basic. If you think something is very difficult, go back to the basic, find a solution. Why is that? Because make the things simple. If you keep the things simple, big problems are very easily solvable. So what I want you to remind you is about basic accounting equation. As you know, the basic accounting equation is asset is equal to liability plus equity. That's our basic accounting equation. Now, what we saw on the 1110, we saw in 1110 that these assets, that we have two type of assets. We have a current assets and we have a long-term assets. On the liability, we have exactly the same. We have current liabilities and we have a long-term liabilities. So assets and liabilities follow the same pattern. So there's nothing scary here. And now we're going to the point of what's equity and what's equity consists. Now, this part of the course, so far in the 1110, we saw the basic accounting equation. We were dealing with the balance sheet, income statement, retained earnings, what's happened with the retained earnings, who keep the retained earnings, and we saw that equity, one section of the equity is contributed capital, the other one is the retained earnings. And the retained earnings coming not from out of nowhere, they're coming from the normal operating cycle of the company. And in terms of the company is going to generate sales, obviously there will be expenses in order to generate the sales. If the sales are more than the expenses, then the company is going to generate income. Once the company keep that income, corporation keep that income in the corporation, that becomes retained earnings. The other option for the company is not to keep the income in the company by distributing it to the owners of the company as a dividend. And if the income that company generates is equal to the dividend that is distributed to the owners, there will be literally no retained earnings in the company.
Sorry,
That's the
just a quick question. The
yes.
CC there stands for what exactly? Like before?
CC, contributed capital.
Oh, okay, thank you.
Contributed capital. We're gonna build to this today on the contributed capital. Now, what I want you to remind you on the 1110, we talk about the assets. We cover the assets. We cover the current assets, cash, accounts receivables, inventory. This term in 1210, we're going to cover long-term assets or property, plant, and equipment. Plus, we're going to cover the investments. Also, we're going to cover current liabilities and long-term liabilities. So far, we didn't cover any liabilities, so that will be our objective to cover the liabilities. And also, we're going to cover the equity in terms of contributed capital. We already know the retained earnings from the 1110 from where the returning comes. Retained earnings comes from the by the books come from the income summary account. Why income summary account? Because at the end of the period, you have to close all the sales and the expenses into the income summary account. And once you already remember this, if the income summary account, that's cumulative account that there should be no balance in that account at the end of the period. So what we're going to do at the end of the period, we're going to transfer the sales and anything on the credit side on the temporary account, which are income account, we're going to transfer it on the credit side of the income summary account. All the debits, it means expenses and some sales return, anything like that, we're going to transfer it on the debit side of the income summary. We're going to balance this account and we're going to see where we are. Are we having a debit balance or are we having credit balance? Not bonus, balance, right? So if the income summary end up with credit balance, that means we have retained earnings. If the income summary account ends up with debit balance, that means we have loss. So that's a quick overview on the basic accounting equation, what we cover in 1110 and what we're going to cover in 1210. Again, we're going to start with the equity. Why the equity is important? Because the equity is one way for the company to generate a capital. Then you're going to ask me, what means capital? Capital means all the available assets that company have, which are available for the company to generate operating income. If you don't have a capital, you cannot go in the production or you cannot fulfill your main purpose of the company, which the main purpose of the company to produce a product or to sell the merchandising or to provide the services. Only one reason, to generate sales. And again, if the sales are more than expenses, then the company will be happy, owners will be happy, they're generating income. But they have to get the capital. Which are the options for the capital? There are only two options for the capital. As you can see, this capital here is equal to the sources of the capital. Now we're going to the sources of the capital. One source is borrowing or debt. The other source is investment. And today we're going to see from where those investments come from and how we're going to present those investments on the balance sheet of the company. Let's go back to the slides and start now with the first objective today is to identify the characteristic of the corporation. What kind of corporations we have? Now we, as organization of the business, we already saw we have a proprietorship, you have a partnership, and we have a corporation. Proprietorship is when one person decide to work as a solo proprietor. He just start the business and that's it. He pays individual taxes. The liability that he taking is with everything that he has, and he start his business. The other form of business is the partnership. Partnership, we're going to see in chapter 12 how we're dealing with the partnership. The third option is the corporation. Now, on the corporation side, we have two type of corporations. One is public corporation, the other one is private. Why is private? Because we don't know anyone to know about our corporation. Not true, but close enough. So public, what means public? We're gonna tell everybody that we. So if the question, let's make it funny. If I open my own company and if I post on LinkedIn and available for all the people that know me that I open my company, does that mean I have public company? Obviously not. So what would be the public company? Public company is the one who are listed on the stock exchange market. They are listed somewhere. That means their shares of that company are available for the public. What standards they have to follow? They have to follow international financial reporting standards. Private company, they don't have to be listed on the stock exchange. Obviously, their share will be traded privately and they're not available on the stock exchange market. So you cannot buy shares of the private company. Which standards they have to follow? They have options. They can choose between accounting standard for the private enterprises or international financial reporting standards. Now, why somebody wants to, if the private company, which is not traded publicly, which have one owner or two owners, why they want to use international financial reporting standards to make it more complicated and pay more to the company that's doing compilation? The only reason will be if they want to go public. That will be the only reason. But we're going to see this a little bit later. Now, the characteristic for the corporation is, first one, the corporation is a separate legal entity. What that means is corporation is not associated with the shareholders. So shareholders are the shareholders, corporation is corporation. That's a separate legal entity. That gives ability to the corporation to have continuous life and to be transferable from one owner to another owner. So once the creator, let's say, let's get the company Ford. Who is the owner now of the Ford? Probably Ford family. But is it the person who initially opened the Ford company? No. Ford Corporation? No. Did the corporation, did the business end up with the person who opened the company? No. That means continuous life. That's why we have a Coca-Cola, and Coca-Cola keep going, keep going. And it's easily transferable from one person to another person. There's no mutual agency. It means the owner cannot sign bonding contract. Example will be, imagine this, I own one share of Apple. I own one share of Apple. I decide to go to Las Vegas. I'm going to MGM Grant and asking, I want $10,000 on Apple account because I have one share of Apple. Can I do that? I own one share of Apple. Can I get $10,000 on behalf of Apple and play on the casino and spend Apple money? What do you think? No, that will be the right answer. No, you can't. Why? Because owner has nothing to do with the corporation. There's no mutual agency. I cannot sign binding contract for the corporation by having one share or two shares or 100 shares. The corporation has their own structure, managers, they're dealing with that. Separation of ownership and the management. Owner of the company, it can be the manager, but it's not necessarily to be the manager. The corporation pay corporate taxes following the government regulations, which are unique, and also have unique cost of the corporation, which might be direct cost of the board of directors, officer insurances, anything like that. Once you open your corporation, I strongly suggest you, first thing that you have to do is do the insurances to protect your income. If something goes wrong with the corporation, you'd not to be liable, the insurance to cover all the losses and if everything goes bad. Now, which are the advantages, disadvantages of the corporation? First advantage will be uh, corporation can raise money and also can raise more money than proprietors and partnership. Has a continuous life. I can easily transfer the ownership. I don't have to close the corporation because I want to sell my shares and somebody else become an owner of the shares. There's no mutual agency, so nobody can buy the shareholders. Now, whoever has a share, he cannot make a decision on behalf of the corporation. And the shareholders have a limited liability. They still have liability, but it's limited. Usually, it's limited to their contribution or their investment. So if you have to open private corporation by yourself, so how much you have to invest? Well, invest $10. $10, give yourself a 10 shares. Now the question will be most likely will be asked me, why not investing $1? Why do you have to invest $10? Because if you invest $1, most likely you're gonna go with one share. You don't want to have one share in the corporation. When you initially set up the corporation, you have to think big. And what that means someday you may, even if it's private corporation, you may get involved, have somebody else involved. But if you have only one share, then you have to give him that share. If you have 10 shares, you can sell somebody 2 shares and you still have the ownership of the corporation. If you want to leave the company to your kids, sell them 8 shares, keep yourself 2 shares. And that's going to give you access to the retained earnings, give you access to the dividend. If you have, again, if you have 1 or 2 shares, there's not much game there. Keep that in mind. Disadvantages, ownership and the management are separate. It doesn't matter how much I want the company to generate income. If the manager is not doing his job, the company still start losing money. Earnings are sometimes the earnings are subject to double taxation, and we're gonna, for those of you who are gonna continue with accounting, they're gonna see that. Government regulation can be very expensive to apply with the government regulations. May happen which are very unique to the corporation. Board of directors often require special insurance against the lawsuit. Again, if you have a corporation and if you decide to go big the first time, first thing that you have to do is insurance. Let's keep going. Organization of the corporation. What's the organization of corporation? First thing that you have to do, if you want to open your corporation, is very easy. You probably is going to take you, I wish I can tell you it's going to take you 24 hours, but it's not going to take you 24 hours. And the reason for that is because you have a 5 days for name search. What's going to happen is first you're going to send the application to the BC, which is in Victoria, to choose your name. They're going to ask you choose your name of the corporation, and you're going to choose a name. Then they have to do research in the entire database that they have for all the company which are registered in Canada to see is there duplication of the name. If there's a duplication, you cannot use that name. Once those 5 days pass and you choose some unique name, you do your job, and they say that you have a certain amount of time to get that name. If you miss that point, that name is not available anymore. So that's how you have to register the corporation. What you need to register, you need article of incorporation. Now depends what kind of business you're going to do, provincial or the government, then you're going to have a different registrations. Articles of the corporation is going to authorize the corporation to issue shares and to set by law to govern by the corporation. It's going to explain about the control of the corporation, which resists on the shareholders. Shareholders have to elect board of directors. Now, even if you have 2 shareholders, one of the shareholder will be director, the other one will be secretary. Something like that. Those 2 directors going to set the policy. They're going to elect the chairperson. They're going to appoint the president of the company. Again, if you're a simple private corporation, formally those terms still exist. The easy way is it costs around now probably it's around $500 or $600. Get a lawyer. They're gonna do the corporation. They're gonna do registration for you. Now the lawyer, what the lawyer is gonna do, he's gonna register the corporation on his own name, and when the registration pass, he's gonna transfer the shares to you, and you have the company with the shares. Remember, don't issue initially only 2 shares. Less flexibility if you have only. So what will be the structure of the corporation? This corporation will be shareholders. The shareholders, why the shareholders want to open the corporation or to invest in corporation? There's only one reason: they have an excessive amount of cash and they're looking for more opportunities. More opportunities is they're looking for more cash. So what they're gonna do? They're gonna elect board of the directors, which board of directors is gonna have only one purpose: to serve the shareholders with cash. Now the board of directors, now the shareholder job is done. I elected board of directors. They know what they want. I want cash, so let them do their job. Now the board of directors start electing the president, and now becoming a little bit more decentralized system. The president start electing the vice presidents and all the other things which are needed for the corporation to exist. We're going to the point of the share capital, and the share capital is the certificate which is issued to the investor. So the share presents a certificate which is issued to the investor or the owner. Investor is also co-owner of the company. So now, if you have one share of Apple, is that make you owner of the Apple? In a way, yes. Can you do something on the Apple's behalf? No. Therefore, legal entity. We have two types of shares. We have authorized shares and we have issue outstanding shares. Now, on the article of incorporation of the company, it's going to be specified what's the maximum number of shares the corporation can issue within the life of the corporation. Usually, pick high number or put unlimited number of shares. I can issue unlimited number of shares. Do you have to issue those one? No, absolutely not. So then how many I'm going to issue? As many you think you're going to sell. So then you're going to have numbers. Now we're starting with the numbers here. You're going to have, let's say, 1 million authorized shares. I'm going to issue only 50 shares because that's how much I'm going to sell. Once you sell the shares, they become outstanding because, again, the shares belong to the company. They don't belong to the shareholder. Shares belong to the company. For the time being, when you sell the share to the investors, he become a shareholder or the owner. Why? Because he holding that share. Now that share is outstanding for the corporation point of view. We're looking everything on the corporation point of view. Make sense? Is that share makes him the owner of the company? In a way, yes. But can he bind the company and do something on behalf of the company? No, he cannot. You can look at the share, same thing like your international passport. It's your passport, but at the end of the passport says, if somebody find this passport, return it to the near embassy of the country of the passport. It doesn't say return this passport to the owner, which is on the page 2 at his address. It says this is a property of this such a such government, and if you find this passport, return it to the nearest embassy of this country. So yes, I'm holding the passport. Yes, I'm saying my passport. Is it actually my passport? No, it's not. Same thing with, if you have to put this one in mind, same thing with the shareholders. I own the shares. Is it my share? In a way it is, but in general it's not. Why? Because it's outstanding for the corporation. The corporation can ask that share back, can buy it back, can repurchase it back, or I can sell it. So it's mine, but only temporary, as long as I'm holding it. That's why I'm called shareholder. So the shareholders' equity have two things, two base sources. So from where the shares equity is going to come? First, from the contributed capital, which will be the capital that's coming from the shareholders or the investors in this case. So I have cash. I want to invest my cash. So what I'm going to do, I'm going to look for the opportunities. One opportunity is to go and buy GIC. When I buy GIC, what I'm actually doing, am I investing or lending money? More like I'm lending money. Why? Because I'm getting guarantee return in form of the interest. As long as you're getting interest, you're not investor. You're a lender. So on that reason, as you already know, if you're a lender, you're limited on the return. You can only generate such. But if you invest in the corporation, then your return can be way higher than the interest that you can get as a lender. But that's going to make you shareholder. And once you give your money to the corporation, that will be contributed capital. With that capital, the corporation can do whatever it wants. Now the catch is you're investing, let's say, on the initial public offering, you're investing $100,000 in the corporation X. Does the corporation have to give you the money back? Or can you, after that, go to, is the equation involving shareholders' equity? Not yet. We're going to come to that one. So let's pretend that, what was this? What was saying? You're investing in the company, you have that excessive amount of cash. Now, I'm not chasing now the interest. I'm investing $100,000. That the corporation have to pay that $100,000 back to me? The answer is no. But if you lend your $100,000 for somebody who borrowed the money, does he have to pay you the money back at a certain period of point of time? Yes. That's one trick with the equity. When you invest in equity, you're not going to get your money back. But if you lend the money, yes, you're going to get your money back. So let's keep going with this contributed capital. Contributed capital from the shareholders. Let's imagine that the corporation received $200,000 cash and issue common shares to the shareholders. What will be the journal entry? Journal entry will be corporation gets cash. On the credit side, we start keeping records for who invested, how much invested, and that become a common shares account. We go opening common shares account for that initial investment from the whoever invests in the company. Now the issue shares, as you can see, they don't have to be equal to the amount of the money that has been invested. But once we have the amount of the money that has been invested and the number of shares that was issued against that amount of money, we can easily see how much is the book value on the issuing. Now, profitable operations is definitely going to produce net income. What means net income? Net income sales are more than the expenses. What's going to happen if we have a positive net income? That's going to increase retained earnings. Now, the retained earnings is part of the shareholders' equity. Why is part of the shareholders' equity? Because that's the reason why the shareholders invested in the first place. That's why they created that capital, bring their investment to create the capital, which capital makes the company working to generate income. If the income is positive, if the corporation is profitable, there's an income that stays in the company. That income is the return that the investor gets as a retained earnings. Retained earnings, again, comes from the income summary account. At the end of the period, we're going to close the sales into income summary, expenses in the income summary. Once the income summary end up with credit balance, we're going to debit income summary. We're going to create retained earnings. And now we have retained earnings. Now, what's going to happen if for some reason the sales are not enough to cover the expenses? We're running unprofitable business, means we are generating loss. What's going to happen with the loss? Loss is going to start reducing retained earnings. As long as there are previous retained earnings. What if there's no previous retained earnings? Then we have to, the capital of the owner is going to start getting less. If the retained earnings account end up with debit balance, that means we have a deficit. Now, on the basic accounting equation, contributed capital plus the retained earnings give you the shareholders' equity. Now, imagine the shareholders invested $100,000. Current retained earnings has a debit balance of $20,000. What's the actual equity for these people? $80,000. What that means? That means that the money that they invested are not longer in the company. Where they are, they went through the expenses somewhere else. They losing money. Where did they go? Whoever paid the expenses. Now the dividend to the shareholders. Now let's imagine the company is profitable, everything goes well, the sales are more than expenses. So we have the income. That income is transferred to the retained earnings. Means that these investors now they can enjoy some payback. What will be their payback? Payback will be dividend. Profitable corporation, then they only the profitable corporation may, as you can see, pay attention to the verbs here, may distribute. Doesn't say have to distribute. Doesn't say must distribute. May distribute. What that means may. May is they may distribute or may not distribute cash dividend to the shareholders. Now the dividend will be considered similar like a withdrawal from the partnership or proprietorship. What's going to happen when we give the shareholders dividend? Well, cash dividend in this case. Well, obviously, if the corporation give the cash to the shareholders, that cash is not longer in the corporation, so we're going to give them cash. The cash assets going to go down, and the retained earnings is going to also go down. So, if we want to give the shareholders cash dividend, what do we need to do to have? We need to have retained earnings, and we need to have cash. You're not borrowing cash to pay your shareholders dividends. You're only borrowing cash for the activity that generating cash. Paying dividend to shareholders is not cash generating activity. So you're not borrowing cash to pay the shareholders cash. Remember this, that's a concept from finance that you probably, if you once you start taking the finance courses, you're gonna see how to manage the cash. Now, the owners of the shares are entitled, the once they have the ownership of the shares, that gives me some rights, entitle me to something. What kind of rights I have? Once I have the share, I can decide, should I keep it or should I sell it? I have the rights to sell the shares. If I don't like it, I don't like the color of the share, I can sell it, as long as there's somebody to buy it. That's another thing. And as long as there's a value in the share. So who's going to buy the share? Who see the value in the share? If the share doesn't have the value, then it will be hard to sell it. Now, the next thing that you have once you become a shareholder is you have the rights to vote on the shareholders meeting. Some, I mean, I don't know now, but before some of the richest corporations, what they were doing, they getting their shareholders annual meetings in Las Vegas on the expense of the corporation. Right? That sounds a nice idea. So you're gonna go there, you're gonna vote. What you're gonna vote? Board of directors. They have the rights. Once you have the shares, you have the rights to receive the proportional share of the dividend, proportion to the number of the shares that you own. So let's say we have $1 million, 1 million shares outstanding, and you owe one share out of 1 million. What's the proportion of the dividend that you're going to receive? If the corporation issue, let's say, declare $100,000 cash dividend, you're going to get 1/1 million times $100,000 share cash available. That's how much you're going to get. Also, you have a right to receive the proportional share of the assets if the company decides to stop working. Let's say corporation doing well, but at some point they decide, you know what, that's too much hassle every year, a year after year after year. We're sick of this. We're closing the corporation. What's going to happen now? They're going to sell all the assets for cash. With the cash, they're going to pay all the liabilities. And whatever left in the cash, proportionally, we're going to be distributed to the shareholders. And you have the preemptive rights. That will be the right to maintain one the proportional ownership of the corporation. What that means is if the corporation decide to issue new shares, and let's say at this point before the new shares are issued, I have 20% of the ownership of the corporation. Now, if the corporation decides to issue another 100,000 shares to the public, that's going to reduce my percentage. But because you have preemptive rights, that means after the issuing 100,000 shares, you still have to keep your 20% of the ownership. So what's going to happen? The corporation is going to offer you amount of shares, which when all the shares are sold to the public, you still have 20% ownership of the corporation. So that's not going to diminish your percentage. How are we going to record? Let's go recording issuance of the shares and prepare the shareholders equity section. Now we're going to do some calculation here. So first, in order to issue the shares, now the corporation, they can sell new shares directly. But they have to engage an underwriter and to sell the shares to their clients. Who is the underwriter? Underwriter will be the big corporation. If you want to watch the Wolves of Wall Street, and they're Leonardo DiCaprio in Joe Hill, they doing that initial public offering in one of the companies, show company. and you're gonna see what's happening. How with the underwriters, they have their access to the clients and they selling to their clients. Uh, in order to sell something, you have to have a prospectus, which is gonna give you this beautiful ideas. If you buy those shares, your life's gonna change, and you're gonna be a new person, and suddenly those money is gonna start flowing to your pocket in the forms of dividend and other means, unless you lose everything. But go for it because the future will be bright. You have all the prospectus. And then we go into the initial public offering. Initial public offering, you have to understand this. On the initial public offering is the only time when the corporation is going to get cash. That's it. Only on the initial public offering. This means the prospectus that relate to the first time of the corporation shares are offered to the investors of the public. Once the initial public offering pass, what's going to happen with the share after the corporation gets nothing? I want you to understand this. There's only one time and one time only when the corporation gets cash from the investors. That's on the initial public offering, when initially the corporation offered the shares for the public. After, once the shares in the public, and if one person then sells the shares to another person, corporation gets nothing. If the one person who initially bought the share from $10 from the corporation and the share price went to $100 and he sold it to a second person for $200, that means he generating $190. That is for the person who has the share. Corporation gets nothing. Now, in order to do this initial public offering, if we are a corporation, there's a special site which is called System of Electronic Document Analysis and Retrievals, in short, SEDAR, where you can see all the information about the public companies. So what you have to do is, I'm gonna drop this one down for a second. I'm gonna open any search engine. Let's stay with Google. I'm gonna share my screen so you can see my screen. And I'm gonna paste that Cedar thing. And you're gonna see the searches, which is Cedar. And once you click here, you're gonna have access to this website, on which website you can start searching for the companies or for the corporation. All the public corporation have to disclose all the available public documents in this website. So if you're looking for the investments in the public corporations, and if you want to see their financial statements, income statement, balance sheet, of interim statements, quarterly statements, everything is available here. All you have to do is search. You can subscribe yourself for the financial documents alert. You can subscribe for the action alert. You can do anything that you want. You can go with the search with the public disclosure documents by the company. You can go with the list. You can do so many things. And here with the search, you can find whatever you want to find. A very extensive search, play a little bit. Again, if you're planning to invest, this will be the page. You can find everything that you need. Besides all the investor websites, which also give you additional information with a little bit analytical things. Here, you're not going to see the analytical. You have to do the analytical things by yourself. But at least you're going to have the information directly from the source, which is the corporation. That's your CEDAR. Common shares. So now we issue the shares. First type of share that we can issue is the common shares. Common shares will represent the most basic form of share capital. We can have many, but you have one class common share. You maybe only one class of common shares, maybe two classes of common shares. Now, the investor who buys the shares, they bear the financial risk. Means that If something happened with the company has nothing to do with it. Investor bearing the financial risk. If they invest in the company which losing their money, investors' decision. We have par value shares, that means they don't have value assigned to the articles of incorporation. We only have issue 10 shares, but there's no value assigned to that shares. Par value is the attributory value. Now, based on the Canada Business Corporation Act, require all the shares to be issued to be non-par value. Again, Canadian Business Corporation Act requires all the shares which corporation issue to be non-par value. We may have stated value on the shares, which may be assigned by the board of directors when the shares are initially issued. Now, let's issue those common shares. Let's pretend that this company issue 6,308,144 common shares for the cash. Stated value is $17 per share. What the company is going to get? Company is going to get $100,011 cash. Company has to pay some discounts and commission expenses related to the purchasing the shares, the issuing the shares. And the shareholder is going to have common share capital of $107,238,618. I mean, those are ginormous numbers, but that's what's going to happen if we issue those shares with the stated value of $17. We wish we can get $17 per share, what we want, because there's associated expenses, which is $1.4075 per share. This if we issue shares for cash. Can we issue shares and not get cash? Absolutely. Then what we can get? We can get other assets. It doesn't have to be cash. We can get equipment, or we can get the building. Who determine the value of the equipment that we get and the building that we get? Yes, we can come up with equipment worth 25,000. How did we come up with this value? Well, it's very simple. We're going to use the current market value. And that will be when the shares are not actively trading and if the par value cannot be determined. We're going to use the market value of the assets that we're receiving, and we're going to use that value to record the common shares in the equity section. Okay, common shares, we're done with the common shares. Let's see what other shares the corporation can issue. The corporation can issue preferred shares. What means preferred shares? They have special rights. They have some preferences. What will be some preferences can be receive dividend before the common shares. So when the corporation declare the dividend, preferred shares going to get first dividend, and if there's anything left, that's going to go to the common shares. Another benefit will be once the company come to the end, preferred shares is going to get whatever they have to get, and if there's anything left, that's going to go to the common shareholders. Also, they may have a fixed dividend. What's the drawback? Drawback is that preferred shares cannot vote. Now we can have several classes, and they have a futures. What will be a future? It can be cumulative, can be convertible. We're going to come to this a little bit later and explain what's cumulative, what's convertible. Now the common shares, in that case, so as you can see, now I have the capital. which on the other side of the equation have a liability and equity. Let's say I'm starting to closing the company. Now, what do I have to do? To convert all the capital that I have with different assets that I have, long-term, short-term assets, long-term assets, I have to convert everything in cash. Once I convert everything with cash, I have to bring the accounting equation to zero. So first I have to clear all the liability, bring the liability to zero. And then if there's anything left, I'm going to start paying to the shareholders, which will be the first that's going to get preferred shareholders. From the cash that I left after I sold the assets and paid the liability, preferred shareholders come first. I'm going to satisfy their needs. And if there's anything left, it's going to come to the common shares. That's why the common shares represent residual ownership of the corporation assets. Means if there's anything left after we pay the liabilities and all the claims on the preferred shareholders, then common shares gonna get the rest. Whatever left. That's why they're at the end. They're residual. Now let's issue some preferred shares. Preferred shares, those are counted for the same as a common shares. So basically, you can get cash, you can get assets. Let's pretend we issuing 1,000 shares for $100 per share. And they pay fixed dividend at 10%. So what we're gonna do, we're gonna debit cash account with $100,000. We're gonna credit preferred shares account with same account. As you can see now, we're not going with the shares, just shares. Now we start distinguishing common shares, preferred shares. Then we're gonna make a note that we issue 1,000 preferred shares, which paying $10 dividend, and we issue them for $100 per share. On the balance sheet, we're gonna have a contributed capital. Now we're gonna have preferred shares, common shares, and the next section will be retained earnings. Let's see now what's convertible shares. Convertible means they can be switched from one to another. I can exchange one type of classified shares to another. So basically, preferred shares, the only option that they have for conversion is to be converted into common shares. Why somebody wants to convert, why the corporation wants to convert preferred shares to the common shares? Because the corporation may want not to pay the fixed dividend which is attached to preferred shares. Once they become a common shares, if we have a dividend, if you want to pay a dividend, they're going to get the dividend. We don't have obligation to pay the dividend. Remember that. Example in this case will be 100 preferred shares, which are purchased for $100 per share. That means 10,000. Now the 100 preferred shares are convertible into 700 common shares. Every time when the shareholders want to do that. Now, if the shareholder choose to convert, what's going to happen? Now, the number of the shares that the shareholder is going to get is obviously for the 100 preferred shares, they're going to get 700 common shares, but the amount on the balance sheet is going to be exactly the same amount that they initially contributed. So the 10,000 from the preferred shares is going to move to the common shares. That's why we're debiting preferred shares. So we're closing the preferred share account and moving everything to the common shares. How this is going to be presented on the balance sheet? On the balance sheet, now pay attention here. I want you to see this. We're going to have two sections. First section will be shareholders' equity. If we have to check only the shareholders part of the balance sheet, this is a partial balance sheet, which is including only the shareholders' equity section. You have two sections, subsections. One is the share contributed capital. The other one is the retained earnings. From where the contributed capital came from, in this case, they came from the preferred shares, which are $5, paying the dividend of $5. company on the article of incorporation state that they can issue over the life of the corporation 10,000 shares. So that's why the 10,000 shares are authorized. Currently, 900 out of the 10,000 shares, 900 were issued and outstanding. The book value is $90,000. On the common shares, on the article corporation states that the company over the life of the corporation can issue $100,000 shares. Those one are authorized. Out of those 10,000 shares, 100,000 shares, sorry, the company issued and sold to the public 25,700 shares, which have book value of $160,000. That brings our contributed capital to 250. Plus, this corporation have a very healthy retained earnings. As you can see, $743,700 retained earnings. So the shareholders' equity is $993,700. So let's see. What shall we do? Shall we go with debt? Shall we go with equity? If we want to raise capital. Now again, in order company to work, you have to have a capital. From where that capital is going to come, you have only two options. You may think that you have more, but you have only two options. Either you can borrow money, either you have to get somebody to invest. So then you're going to have questions that you have to ask. What should I do? Should I raise my capital through debt or should I raise my capital through equity? Let's say I'm going to go with the equity. What I have available, I have two options here, common shares or preferred shares. What's interesting with the common shares? We may or may not pay dividend, but those common shareholders, they're going to start affecting our business operation. Why? Because they can vote. Do we have to repay the money back? Absolutely not. Is the dividend create tax implication for the corporation? No, it doesn't. Why? Because the dividend is paid after taxes. How about preferred shares? So let's say, okay, excuse me. One option was common shares. Let's see the second option. Second option is preferred shares. What do we know about the preferred shares? We may again declare dividend. We may skip the dividend, but we have to be careful. Is this preferred shares cumulative or not? Can they affect the business model of our corporation? Absolutely not. Why? Because they don't vote. They cannot exercise any part of control. Sorry. Do we have to repay the money that we get through the preferred shares? No, absolutely not. Is the dividend create some tax consequences? No. Dividend is not taxed. Again, dividend is paid after taxes. This is for the equity side. Now let's think about the debt. Again, you're not gonna, one thing that you have to understand, you're not gonna raise capital through the short-term liability. Short-term liability is used to deal with the short-term assets. So if you want to raise the capital, which you're gonna use for the company for more than 1 year, means you're planning to operate over the period of years, then you have to think to generate your cash through the long-term debt. Long-term debt is a little bit cheaper than the short-term debt. Plus, it doesn't create so much burden at the beginning. Means once you borrow in the long term, in the very beginning, you're going to have the cash to start generating the income, which is going to help you to pay that long-term debt. So, what do we know the long-term debt? We have to pay something. What do we have to pay? We have to pay interest. Can I skip the payment of the interest? Absolutely not. Why? Because if you try to skip the payment of the interest on the mortgage to the bank, then see what's going to happen. If somebody lend you money, does he have control over the business? Absolutely not. He cannot tell you what to do and what not to do. Payment. Do I have to repay the money back? Absolutely. How much? All of it. But the interest that you're paying on the long-term debt, you can deduct it for the tax purposes. So now the ethical issue is how are we going to assign the value for the shares, which we issue to the asset? Because I, as a shareholders, open my company, I can buy a laptop for $1,000, magically come up with the market value of that laptop, $100,000, and invest it in my corporation. Now I have long-term assets, $100,000, shareholders' equity, $100,000, and can go to the bank and borrow $50,000 right away. And bank's gonna give me. Why? Because I have assets. I'm asking 50% of my assets. So if something happened, I can back up my loan with the assets that I have. But the problem is my only asset is a laptop, which I magically come up with the idea that that laptop market value is $100,000. Can I use another example here? Absolutely. I can open company with the promissory note for $100,000. Promissory note is going to come as an asset. Then I'm going to have a shareholders equity, common shares. I'm going to issue common shares for that promissory note for $100,000. And then again, I can go to the bank and ask for $50,000. Why? Because I have assets of $100,000. Now the question is, how realistic is that promissory note? That will be the only question. So basically, we can start business based on the nothing. And we can create a company, we can start corporations, we can start financial tricks and games, and we can create the entire economy based on nothing. Empty. When you go back to the basic, there's nothing. Now, the first thing that I faced these ideas, I was taking this course, financial, I can't remember exactly the name, but financial, it wasn't accounting, it was financial law, I believe. And the professor there, he told us that all the transactions that happen on the stock exchange, all the transactions has happened everywhere on the stock exchange, commodity stock exchange, share stock exchange, 99% are speculative. Means there's nothing. Only 1% there's some actual transaction. Everything else is speculation. That brings it to idea when we come to the how we're going to raise the capital, you can easily see and you can think about the games that you have if you start opening your company. Organizational cost, what we're going to do with the organizational cost. We have two options here. And pay attention for this because if you go to CPA, CPA asks for this question. on the organizational cost, because there's a difference between how you're dealing with the organizational costs in the private corporation and public corporation. In the private corporation, as you can see here, organizational cost is intangible asset and has to be capitalized on the balance sheet. When International Financial Reporting Standard says, hey, expense it. Where is the catch? The catch is in the accounting standard for the private enterprises says this. Yes, you have to capitalize it, and you can amortize it over the first year of operations. So at the end of the first year, both standards is going to end up with the same result. The only thing is, in the International Financial Reporting Standards, you're going to expense the organizational cost right in the beginning, where in the accounting standard for the private enterprises, you're going to expense it at the end of the first year. So when you look at the financial statement at the end of the first year, in both standards, organizational costs will be in the expense. Different way, but it's still going to be in the expense. Now, the organizational cost here will be, again, organizational cost is the asset, as you can see here. Corporation pay fee $5,000. The investment dealer charge $15,000 to be paid with the 2,000 common shares, selling of 30,000 shares for 225. So what's going to happen? Company is going to get $225,000. They're going to pay the incorporation fee $5,000 cash, which is going to be capitalized. Then the $15,000 that they're paying for the investment dealer, part of the organizational cost, which is going to be capitalized. So now I have $20,000 sitting on organizational cost. I have common shares for 240,000, and I have $225,000 cash. Cash dividend. Let's see what's going to happen with the cash dividend. Before we see this, the cash dividend, do you want to have a break?
Yes.
Okay, let's take a break then. How long break you want?
I was thinking like 7 minutes. Would that work? Or
7 minutes?
or
Uh,
5 minutes? Oh,
so you want me to start as the 2035 or 2040?
I was thinking. I'm just curious what others have said.
What the other people saying?
I
This,
think 2040 would be great.
yeah,
2040?
20.
Let's make it 2040 then.
Okay.
Sorry guys, some technical difficulties here. Are you guys there? Can you guys hear me?
Yeah, I can hear you, Ivan.
Okay, awesome. The power is gone, so everything disappear. But now I'm back, and now we can continue with our journey. Let's resume the recording and keep going. Now, the only tangible assets that you're gonna have, that's organizational cost. But again, I told you, in the accounting for standards for the private enterprises, they allow you to amortize these assets within the first year after operation. So let's go with the dividend and how we're going to account for cash dividend. Remember, investors, they want something. What they want? They want dividend. What else they can also get? They can get a benefit of increasing the market price of the share so they can sell it to another person for higher price. Those are the only things that the shareholders can get. Now, let's go with the dividend. On the corporation, before pay the dividend, he has to declare it. So first we have a declaration of dividend, and then we paying it. Now the board of directors is the one who decides should I pay dividend or should I not pay dividend, should I declare dividend, should I not declare dividend. In order to declare dividend, two conditions. First, the corporation has to have retained earnings. Second, the corporation has to have cash. Otherwise, how are they going to pay cash dividend? Now, the other tricky part is once the board of director declare cash dividend, at that point, that cash dividend become a liability for the corporation. We have three important dates. One is the declaration date. Second one is the date of the record. And the third one is the distribution date. So let's see first. First one is the declaration date. So usually what's going to stay on the article of not the article of corporation, sorry, for the board of directors, let's say resolution or letter of the board of directors or memo of the board of directors going to state this. The company today, October 3rd, the corporation decide to declare cash dividend, $5,000 cash dividend to the shareholders on the record on October 31st, and the dividend will be paid on November 15th. So what we have? We have the three dates. First day is declaration date. Declaration date is October 3rd. What they did, they declare that they're gonna pay 5,000 cash dividend. Second, we have the second date, date of record. Date of record states only the shareholders who are on the list of the shareholders on October 31st, those will be the one who's going to get part of those 5,000 cash dividend. So, so what that means is don't sell your shares before October 31st. If you sell your shares on November 1st, you're still going to get the dividend, which is declared on October 3rd. But if you sell your shares on October 30th, you won't be on the records on October 31st, so you're not going to get dividend. And that dividend is going to be actually paid on November 15th to the people who are on record on October 31st. So on the declaration date, what we're going to do? In the declaration date, as we said, we have to recognize the liability. What's the liability? Dividend payable. We're showing. Now I have a liability to pay dividend. That becomes a dividend payable on the credit side. On the debit side, from where we're going to get it? From the retained earnings. We're going to debit the retained earnings, we're going to reduce the retained earnings, and we're going to increase the liability. On the date of record, no journal entry is required. This is just date on which we have to check who are the people who's going to get the dividend on the distribution date. And on the distribution date, we actually going to pay the dividend cash. So what we're going to close? We're going to close the liability that we created on the declaration date by reducing the cash.
So is that the grand total of the dividends that are being distributed, or is it the dividends per share that's being
That's the
distributed?
grand total. Grand total. Make sense? In this case, we're not
Yeah.
dealing with how much each share is going to get. We say $5,000 dividend, that's it. Now, if we have to find out how much every single shareholder is going to get, that would be a different story. Here, we're staying with the total amount. Good question, though. Now, let's go with the declaring paying dividend again. Now, what we're going to do if we have preferred shares and common shares? We're going to have different scenarios now. Let's say, assuming that we have 1,000 preferred shares, which pay $5 dividend per share outstanding, plus common shares. If we declare total dividend of $5,000, who's going to get the first dividend? First dividend is going to be given to the preferred shares. How much we have to give them? 1,000 shares times $5 per share. They're going to get 5,000. But the total dividend that we declared was 5,000. How much gonna left for the common shares? Nothing. Sorry, common shares. Next year. The other scenario will be, now we're not declaring 5,000, we're declaring 30,000 dividend. So what's going to happen in this case? Again, preferred shares going to get the first dividend. How much they going to get? $5,000. Why? Because we have 1,000 outstanding preferred shares, which getting $5 dividend. 5,000 goes to the preferred shares, the rest to the common shares. So in that case, we're going to do the journal entry, debit. Retained earnings 30,000. Credit, preferred dividend payable 5,000. Common dividend payable 25,000. Date of the record, nothing, no journal entry. Payment date, debit, preferred dividend payable 5,000. Debit, common shares dividend payable 25,000. Credit, cash 30,000. Job done, everybody goes. This is when we have only preferred shares, which pay $5 per share, and common shares. Now let's see what kind of variation we may have on the preferred shares. We may have cumulative preferred shares. What that means? That means in the year that we're not declaring the dividend that is owed to the preferred shares start accumulating until it's paid in full. Now, when there's a dividend year which the dividend hasn't been declared on the cumulative preferred shares, that dividend is called in arrears. That means we owe that dividend to the preferred shares once we declare dividend. The fact that we didn't declare the dividend doesn't change the fact that we owe them money. Cumulative preferred dividend is entitlement which is tracked and accumulated year after year. When there is no declaration of that year until is declared. Now, when the dividend is declared, first we have to pay all the dividends from the past years. Second, we have to pay the dividend for the current year. Third, if there's anything left, it's going to go to the common shares. Means the common shares are never cumulative. Only preferred shares can be cumulative. So let's see how this is going to work. Let's go again with the example. We have 1,000 outstanding preferred shares which pay $5 per share. In 2023, we're not declaring dividends. In 2024, we're declaring 40,000 dividends. So now what we have to pay? First, we have to pay past dividend for the preferred shares. We didn't pay them for 1 year, for 2023. So we're going to pay them first for 2023, $5,000. Second, we're going to pay them dividend that they have guarantee for them for the 2024. If there's anything left, gonna go to the common shares. So in this case, we're gonna from retained earnings, we're gonna reduce the retained earnings with $40,000, and then we're gonna have dividend payable for the preferred shares $10,000, $5,000 for 2023, $5,000 for 2024, plus the dividend payable for the common shares $30,000. That's on the declaration date. What's gonna happen on the date of record? Nothing. No journal entry. We're gonna check who is the entitled, who is the actual individual who's gonna be entitled for the cash dividend. And on the payment date, what we're gonna do? Dividend payable preferred shares $10,000, dividend payable common shares $30,000 debit, credit cash. And we're done. So dividend in arrears is not a liability. So here in 2023, when we're not declaring the cash dividend to preferred shares, doesn't create the liability. Remember, the liability is created on the date of the declaration. Yes, we owe them $5,000 for dividend for 2023, but that's not liability. So what shall we do? We're gonna show it as a note on the notes to financial statements. Hey, we have a preferred shares 1,000 outstanding, which pay $5 dividend. In 2023, we haven't declared dividend. So we owe $5,000. We don't know, but those preferred shares are entitled to $5 dividend for the 2023. That's going to happen if there's dividend in arrears. Again, it's not liability, but we're going to be reported in the notes to financial statement. If the preferred shares are non-cumulative, then we don't have to worry about it. What that means, in here they're getting, for 2003, they're getting 5,000 because they're cumulative. But if they're not cumulative, for 2023, they're not going to get anything. So there will be only dividend for the current year, 5,000, and the 35,000 is going to go to the common shares. Okay, let's see now what kind of decisions we have to make for the shares and having in mind the share value. What's the terminology here? We're going to have market value and book value. What is the market value? Market value is what's the market willing to pay for a single share for this particular company. Which market obviously is not going to be the original market because we passed the point of the IPO. Then we'll be in the secondary market. That will be the market value of the share. Now the book value will be the amount of shareholders' equity on the company books per share. So we're going to get the shareholders' equity. We're going to see how many shares we have outstanding. Equity divided by the number of shares is going to give you the book value per share. What is the catch? Now, how are we going to determine the market value? And what's the market, how the market value is determined? Well, obviously, market has some expectations. So corporation, what they're going to show? They're going to show the income. They're going to show their financial positions in terms of cash, capital, what they have, what they don't have. They're going to show what they're planning to do with the capital that they have and how they're going to use that capital for the next foreseeable future. And we're going to have some general economic conditions which are related to the market, to the environment, to the technology, to so many things. If you want for the US tariff. And that's going to determine the market value. And if the company is heavily hit by the tariff from US, the market value is going to start going down. But in almost all cases, shareholders are more concerned about the market value rather than any other value of the shares. Why? Because they're thinking that the market value represents the true value of the share, which, as you can see, the market is very volatile. You can easily fluctuate from one side to another side. It can easily change, switch sides, not based on facts, based on rumors. So sometimes you have to be careful when you're making the decisions for buying shares or selling shares. Yes, you have to follow the market, but yes, you have to have your own judgment as well. So that means you have to see the whole picture. That's for the market value. Now, how are we going to get the book value? Book value, first, in order to get the book value per common shares, we have to get the book value per preferred shares. Why do we need the book value per preferred shares? Because we have to deduct that one from the calculation. Remember, the preferred shares always goes first. So what will be the book value of preferred shares? Preferred shares will be they have the preferred equity and the normal preferred shares outstanding. Now, the preferred shares also have liquidation value and dividend in arrears. That will be the preferred equity. Liquidation value, if we have to close those preferred shares, they're not going with the original amount that we get for them, but they might have attached liquidation value. And if they have a dividend in arrears, we have to consider that one. And then we're getting the numbers of the preferred shares outstanding. How are we going to get the book value for the common shares? First, we're going to take the total shareholders' equity. We're going to deduct preferred equity. And then we're going to see how many common shares we have outstanding at the moment. And that's going to determine the book value of the common shares. So let's see here the example. First, we have the contributed capital. We have extract from the balance sheet, and we have the shareholders' equity. Contributed capital, we have two elements. One is the preferred share, which paying $7 dividend. Liquidation value is $90. Cumulative, 5,000 authorized, but only 1,000 issue and outstanding. So for those preferred share, if there's any dividend in arrears, per year will be $7,000. Next one is common shares. We have 20,000 shares were authorized. We can issue 20,000. However, only 5,000 were issued and outstanding. And that's constitute our contributed capital, total $250,000. Then we have retained earnings of $90,000. Now, the other thing that we see here is preferred dividend, since they're cumulative, they have 3 years in arrears. What that means, for 3 years, preferred dividend hasn't been paid, or preferred shareholder didn't get a dividend. So we have to consider that one when we're doing the calculation. So let's do the calculation. Again, first we're going to start with the preferred equity. Book value of the preferred shares. We have the liquidation value, which was $90 per share. We have 1,000 shares outstanding. So that's going to give you 90,000. Plus, they $1,000, 1,000 shares, those are entitled for $7 per share. They've been 3 years in arrears. So don't forget, we're going to pay first the past years or in arrears. Then we're going to pay for the current year. And then we're closing those shares. So we have to consider 90,000 for the liquidation value for plus 28,000 for the 4 years, 3 past and 1 current, divided by 1,000, and we're going to come up with that our book value per preferred share is $118. Now, the tricky part here is I already have my preferred equity, which is liquidation value plus the dividend in arrears. That's 180. Now I can deduct that one from the total shareholders' equity. Total shareholders' equity is not the total contributed capital. Don't get me wrong here. This is the total of everything contributed plus the retained earnings. Now the total book value for the common shares, we're going to use 340,000, which is the total shareholders' equity, less what we get for the preferred share equity, 180, divided by the amount of the outstanding shares, common shares, 5,000. So the book value for the common shares is $44.4. Now, we can use the book value for decision making. What will be that? Once you come up with the book value, 44.40, then comparing the book value with the market value. If the market value is below the book value, that's where you want to buy shares. Do you understand this? Because you're going to pay less than what you potentially going to get. In this company, if they're liquidating everything, you're going to get $44.4 per share. So if the market value is $30, go and buy shares. Why? Because the market hasn't adjusted and hasn't fluctuated the information that this company has. Again, if the market value is below the book value, the share may be undervalued. And this might be a good investment. The other option is the company might experience difficulties. So be careful how you're reading the information. So let's go another evaluation of the company that will be related to return on the total assets and return on the common shares equity. Those are another returns that the investor is looking for. Indicators that shows is the company profitable or not. First, return on the assets. How are we going to get this one? Return on assets is very simple. You're going to get the income that you're generating from the operations. You're going to add the interest expense because the interest expense has been deducted from the net income. You're going to add it in. And you're going to get the average total assets. Means assets in the beginning of the year plus the assets at the end of the year divided by 2. And this company generates for every dollar 3.88%. So, since this is no single rate is good or bad. So what we have to do, we have to compare that rate to the industry or the previous year, which we're going to do in chapter 18 at the very end of the course. And then we're going to talk about this company Is this good thing or this is bad thing? So return on the total assets and return on the common shareholders' equity is not going to be tested too much in this part of the course. We're going to leave those one at the end when we're doing the financial ratio analysis. The next one is return on the common shareholders' equity. What we're going to do there? Again, we're going to start working with the net income, but now from the net income, since from the net dividend is paid on the net income, we're going to deduct the preferred dividend. So whatever we have to pay for the preferred dividends, we're going to take it out. And we're going to, denominator will be average common shares equity. What will be that? That will be beginning plus the ending divided by 2. Simple average. Again, it's a number, but in order to understand this number, we have to compare this company with the other companies. And then we can make a conclusion. Is this good ratio? Bad ratio? Is it within the industry? Is it not with the industry? How are we doing compared to our competitors? How are we doing compared to our peers? And here we're coming to the leverage. Now, leverage is most companies borrow at one rate and they invest in the higher rate of return. I'm borrowing at 5% and investing at 10%. That's you call leverage. Too much debt, however, it may be difficult to pay the interest on the debt. So you have to be careful here. You cannot take too much debt. So you have to mix between the investment with the debt in order you to control that financial leverage. Financial leverage, again, is the capital structure of the company. What means capital structure of the company? Means simply how much you exposed to debt versus how much you exposed to equity. That's how simple it is. Obviously, what do you prefer? To have more equity or to have more debt? Well, that will come with the company and that can come with the industry. Depends where you are. But think about it. If you borrow at 3% and you're generating your capital, and with capital you're generating 10%, you're making 7% right there. But if you get the money from the investor and you're still making 10%, but the investor required 20% return, you won't be able to satisfy your investors. So maybe in that case, you should have more debt because debt is cheaper than the equity. And with the 10% that you only generating from your business, you better borrow a little bit more on the 3%. And that's how you're gonna change the outcome from the equity. Do you understand this or no?
Sorry, can you explain that a bit in simpler terms? I'm kind of
Yes.
lost as to why like the leverage and like how ROE is different from ROA.
I'm gonna be super happy to explain. Watch this. It's very simple. Go back to the basic accounting equation. Basic accounting equation. Everything starts with the basic accounting equation.
Okay.
Assets equal to liability and equity. As a percentage, how much are the assets?
I would say like 50%.
Why 50%? Total assets, how much? Total assets divided by assets, what's going to give you? It's going to give you 1,
One,
correct?
yeah.
How 1 as a percentage, how much is it?
100.
Make sense?
Yeah, yeah.
That's on one side of the equation. But
Okay,
we working with the equation, remember this. So
okay.
what's the options that I have on the other side of the equation? One option is here
50.
to have 0.
Yeah,
So
and
if I have here 0, what will be here the percentage?
that would be 100.
100%. Make sense?
Yeah.
It's going to be 1. 1 is equal to 100%. What's the other option? Any other options? Now I can go here.
50-50?
It can be 50-50. Let's go here. This always going to be equal to 100 minus this one. Correct?
Yeah.
So if I introduce 20% debt, what's going to happen with the equity? It's going to go down.
Yeah, okay.
Make sense? If I introduce 30% debt, then the equity is going to go down. Make sense?
Okay.
Now, watch this. Let's see what's the cost of my capital. Yes, I have 100%, or I have 1, which 1 as a percentage is 100%. And what's the cost of that? So basically, what's my cost of the borrowing? Let's say on the borrowing, I'm paying 7% interest, 0.7. 7% interest, that's 70% is going to be, isn't it? Let's see. On the borrowing, I'm paying 0.07%. Let's make it bigger. That's still 0. No, 7%. 0.7. No, 7. I'm paying 7% on the borrowing. On the equity, however, I'm paying 25%. Are you with me?
Yeah.
Okay. So which one is more expensive for me? Equity or liability?
Ex- I was thinking
You don't,
equity,
I don't, I
actually,
don't, I don't want you to think. Again, on the debt, I'm paying 7%.
okay.
On the equity, I'm paying 25%. So those investors, they want 25% return, where the
Oh, I
all the
see what you
lenders,
mean. So it's
they want
7%.
7%. Which one is cheaper?
7. 7.
7% is cheaper. Now,
Yeah.
so having this in mind here, and if I say that my liability is only 0%, that means I have to pay 25% return to my investors, correct?
Okay.
So how much costs me my capital? Capital is going to cost me, simple formula will be 0 times 7 in brackets. That will be this one here, right? Plus, that will be bracket plus 100 times 25% in the other bracket. So my cost of the capital, to have this capital here, my cost of the capital is 25%. So what that means, from the operation of my company, in order to pay to my investors what they want, I have to generate through my operations at least 25%. Otherwise, the investor is not going to be happy. Make sense?
Okay. Yeah.
But watch this. If if I lever and introduce some debt, let's say because debt is definitely is cheaper, we can clearly see I'm paying, if I borrow money, I have to pay only 7%. So if I put 10% debt only, my cost of capital going down. So I don't have the pressure anymore to generate minimum 25% return. I
See.
can generate less.
Okay.
I can go to 24%. Pay those investors what they want, their 25%, pay the borrowers 7% on the 10% borrowing, and I have my, do you understand? This is your leverage. So the leverage is you're always gonna go in the side which gonna reduce the cost of your capital. So if, let's say, if I introduce more debt, what's gonna happen? If I introduce 30% debt, look at my cost of the capital.
Yeah, that's a good thing that if I'm like, you know, like in that position. So like it's
Exactly.
better than 25%.
Right? So now if a company generate 25% return on investment, I'm paying on my shareholders their 25%. I'm
Okay.
paying my investors 7%, and I keep 5.4% in the company.
Yeah, you're saving.
Make sense?
Yeah.
That's your financial leverage.
Okay.
Debt versus equity. And you're going to see in the financial courses that's expressed with the weighted average cost of capital and all the other terms. But in basic, that's what it is. What's
Okay.
going to happen with one if we increase one or reduce the other? So basically, what's going to happen with the cost of capital if I add more debt or add more equity? So what that means, keep in mind that liability plus equity is always 100%. It cannot go over 100% because it's on the other side of the equation, you have 100%,
Okay.
right? So there's no way here to go 70-70. If
Okay.
this is 30, the other one will be 70. If this one is 20, the other one will be 80. Why? Because on the other side of the equation, you have 100.
Okay.
That's the only game that you have. Do you understand this? So basically, you as a manager, you're on the financial perspective, what you're gonna do? You're gonna chase the cheapest capital,
Okay.
right? Give it less pressure on the company to generate income.
Yeah.
Or in other words, if I generate more, I can keep it. I don't have to give it as a cost of the capital.
So just to reiterate your point, say like, you know, the liabilities were 25% and like down there it's 7. Yeah, like that's a bad thing for me compared to that previous example. Is that
No, this
okay?
so watch this. If I have only 20% borrowing, I
Okay.
have to generate my cost of the capital is 21%.
Okay. And that's a bad thing.
It's cost me more,
Yeah, yeah.
right? But if I add more debt, let's say if I make it 50-50, look at how much cost of the capital is.
That's good for you compared to that other
Of course.
situation. Okay.
Make sense?
Yeah, yeah.
That's a mathematical point of view. Now, in reality, you have to be careful because too much debt actually can crush the company. So you
Okay.
have to find the point. You have to find the point where you can manage and pay for the cost of your capital.
Okay.
Make sense? Because too much
Yeah.
make it difficult to pay the interest on debt. So you don't want to pay too much interest. But then
Okay.
on the financial ratio analysis, we're going to see how this is going to work. Okay.
Okay.
The last thing that left for today is comparison between the accounting standard for the private enterprise and international financial reporting standards. Right now, this is not going to make sense to any of you, but once you start taking the intermediate accounting courses, this one's gonna make sense. At this point, I've got the only thing that I'm gonna uh, notice again and gonna mention again is keep in mind the organizational costs and how the organizational costs are treated between the accounting standard for the private enterprises and international financial reporting standards. That's the main difference here.
Okay.
And the CPA chasing for those. I saw cases that they chasing organizational cost.
Okay.
And that's all for me today, folks.
That's something. Again, you know, like the stuff you said in the middle did not make sense, but after I asked that question, it kind of did make a bit more sense. And I don't know about my other classmates, but like some of the stuff you said at the beginning, there, it d does take a bit of time to digest and so on.
Yeah, I will say yes, but again, this is the first time, this is the first lecture, this is now you're on the Christmas mood or the New Year's break mood. Now, once you have the lecture, spend a little bit time, go over the material again. I'm going to make this lecture available again for your online recording available, and things going to start getting better.
Oh, okay. Okay.
There's a question, do I have to memorize these formulas? If you become an investor, absolutely. But for the purpose of this course, no. Those formulas are even given for on the CPA exam. If you have to take this CPA exam, which requires some calculation of the ratio, the formulas for the ratio are given on the CPA exam, right? One thing that you have to understand is, yes, do you need to know how to do the calculation? Yes. But do you have to remember the formulas? In the real world, when you have available artificial intelligence now, more important for me will be you to know what is in the formula and what changes the numbers in the formula. That will be more important for me. You to know what's included in that formula and you to understand how these numbers is going to change if something changes the denominator or nominator. That's how you can make analysis. For me, it's more important you to interpret the number and you to be able to analyze and come up with the ideas. What's going to happen if this happen? And if this happen, what I'm going to do? What is it is what is it. Make sense? More important is you to start predicting the future. Make one step further. Make sense? That's why I want you to be people. I want you to enjoy your life with the knowledge that you gain.
Yeah, it was very interesting, the lecture, like, how to make something out of nothing, like in the business world. Like that was a very interesting topic in the sense that, you know,
But don't forget, we're not talking about business here. We're talking about pure accounting.
oh, okay.
Right? We just spending time here on the contributed capital, on the retained earnings. Now we're not spending time on the retained earnings from where the retained earnings comes from, but we already know that the retained earnings comes from the uh, income that company generates, and where the retained earning goes, dividend. We already know that.
Okay.
Now we're focusing on those ratios again. The ratios we're gonna come back again on the very last chapter in this course. I'm not gonna keep you so much responsible for the ratios and the calculation of the ratios rather than interpretation of the ratios and what that means and what that means. What means 5.3%? Is it good? Is it bad? What means 3.8%? Is it good? Is it bad? What if that percentage from 3.8 change for 8.3? If that happen, do I have to compare it with something else? What do I have to compare it? And if I find out that this actually trend is in my favor, what can I do? Okay, guys, I'm not planning to keep you any longer because we already passed the time.